Welcome back. Let's focus on one of the major currencies in the world. The Japanese yen dropped to its lowest level in 34 years, trading near 152 to the dollar, the US dollar. That prompted Japan's main monetary authorities to hold an emergency meeting to talk about the currency. This comes, of course, just a week after the Bank of Japan, as expected, ended its negative interest rate policy and nudged up rates by the slimmest of margins for the first time in many years. For more on this, let's talk to an expert. He's Derek Izuel, Chief Investment Officer at Shelton Capital Management. Derek, thanks very much for joining us. How counterintuitive is it that the yen has continued dropping even after the Bank of Japan, albeit expectedly, reversed course on interest rates and finally moved them higher?
Yeah, sure. I think what you're seeing is the fact that the markets or investors had already priced in the fact that the Bank of Japan was going to relax its zero interest or low interest rate policy, and thus had already, priced the yen to reflect that. Thus, it's almost like the news following the rumor at this point, and so it's not that much of a surprise to the markets that this policy has been pulled back, and that the rates are now going to be allowed to rise here a little more freely.
Is it counterintuitive that the yen keeps losing ground against the greenback in an environment where the U.S. Fed is expected before too long to cut its rates?
Well, it's all built on expectations, of course. And while, yes, the Fed is expected to cut rates, again, that's kind of already priced in to what the markets are expecting. So, and then every time we get some incremental news, which we have since the beginning of the year, that perhaps inflation is a little stronger than we'd hoped, that it's being a little more resilient, and we've gone from some prospects of 6 Fed rate cuts to now 3 or maybe even 2. While the actual Fed rate hasn't changed, the currencies are going to reflect that right away, and then that thus the perspective is that okay, rates are going to be higher in the U.S. And this driving force of U.S. versus Japanese rates, which really drives the yen, is going to remain stronger and wider, and the yen is going to be weaker.
The performance of the Nikkei 225 stock market index in Tokyo is unbelievable. It's up 22% this year, this quarter alone. This has got to be a big part of the story. That Japan is an exporting economy, and a cheaper yen makes those products cheaper on global markets.
This is certainly true. There are a whole host of good things going on in Japan from an investor's perspective. The yen helps, and you have seen in the last year and a half a relationship between the yen and the Japanese stock market. The two have kind of worked against each other, and that has sort of neutralized a lot of the returns that some outside investors have been getting from investing in Japanese markets. It seems like the more the Nikkei goes up, the more the yen goes down, and they, to some extent, cancel each other out. But when it comes down to it, Japan, the Bank of Japan's actions is showing that Japan is coming out of this deflationary environment that they've been that they've been in for the last couple of decades, and that's really, really important. As much as we in the U.S. are concerned with inflation and the effect that can have on our equity markets in a negative way, deflation is also a negative influence on markets. And thus, we're seeing the Japanese markets improve as they come out of a deflationary environment. Markets like that Goldilocks in the middle, not too warm, not too cold. They really always like it in the middle.
I think inflation has been above the Bank of Japan's target for about 2 years now, which finally gave it the confidence to nudge rates up. Are there sectors of the Japanese stock market that you like? Are there companies that you like or stocks that you like in Japan?
Sure. So internally within Japan, what you've seen is, to some extent, a microcosm of what we've seen in the U.S. The primary stocks have been driving the rally, have been the larger stocks, the more technology-related or growth stocks, such as semiconductors, and some of the banks. Those have been the ones leading the rally so far. And they have made up or used up half to 2/3 of that valuation spread that we've seen between Japan and the U.S. over the last several years, and maybe even longer than that. Where the opportunities are now is more in the smaller stocks and more of some of the lesser known industries or less growthy industries. With the Tokyo Stock Exchange, and this has been a story that's been going on for a while now, getting a little lost in a lot of the relative news, is the Tokyo Stock Exchange is putting reforms onto the companies into their market. They're forcing them to pay more attention to shareholder value, to return on equity, in a market where nearly half of the stock market has a valuation that's less, where their price to book is less than 1. And they're requiring these companies to really get their balance sheet in order. And that's going to help. That's going to affect small cap stocks and more value-based stocks more than these larger stocks. And I would suspect that the next rally later this year is going to come from those kinds of companies.